Chapter 1. The real problem isn't the numbers. Hi. Finance teams today don't really struggle with numbers. They struggle with how numbers are produced. Companies do what they know how to do. They gain experience doing things the way they've always done them. And over time, that hardens into we've always done it this way. Across the companies I've worked with, I have noticed some very consistent patterns. Not everywhere, but often enough that they are now worth calling out. At the point where I usually join, four things tend to show up. The first one, forecasts are often little more than just trend projected forward. P&L balance sheets are patched together, and then cash flow quietly becomes the bridge between the two. Whatever doesn't quite line up in the P&L or balance sheet, cash then absorbs it. Second, business partnering exists more as an ambition than a reality. Budgets are built in isolation, management teams are present, but they are not really shaping the numbers, and they don't really and clearly see how their operational decisions translate into financial outcomes. And then comes the third one. Headcount plans live somewhere else, usually in some HRI files, and they rarely flow properly into finance, which means staffing forecasts, cost projections, and source planning stay disconnected from the financial model. And fourth, systems become a double-edged sword. ERPs are excellent at centralizing transactions, but they rarely capture the operational drivers that actually generate these numbers. So, finance ends up managing two parallel worlds. One, you have ERP for accounting, and then Excel for real-world planning and forecasting. The consequences? Even for companies with, say, 50, 100, or 250 people, companies that should still be nimble, there's a growing need for a middle path. A system that keeps flexibility and intuition of Excel, but introduces ERP-grade structure, integrity, and consistency. A system that doesn't just report the past, but connects operations to finance in a way that decision makers can actually trust and act on these things. And that's exactly what I'm about to show you. Chapter 2, how the model came to exist. The model you're looking at today didn't appear fully formed. It is a result of more than 15 years of hands-on evolution, learning from real business problems, refining solutions until they actually worked in practice. Back in 2008, I was brought into a private equity-backed buy and build initiative. This was a fully and highly acquisitive business operating across geographies, currencies, and regulatory environments. Nothing was uniform. Chart of accounts didn't align. Revenue streams differed. Revenue recognition policies varied. Business models were mixed. Some entities were early stages, others were more mature. If something could vary, it did. And here's the thing. In a PE environment, the clock is always running. The LBO structure means, therefore, that interest and administrative costs start accruing immediately. So, integration isn't optional. It has to happen, and it has to happen real fast. And surprisingly, all the challenges I mentioned earlier were present, just at scale. Fragmented forecasts, disconnected department systems that couldn't capture operational reality. I started by doing something very practical. I brought together multiple independent models, workforce planning, revenue forecasting, cost management, capital allocation, and connected them into a single integrated financial framework. The objective was simple but ambitious. Because to build a model that flows cleanly into the three principal financial statements, that is the profit and loss, the balance sheet, and the cash flow statement, what you hear as the three-statement model, while staying grounded in the operational drivers of the business. And from there, it didn't stop. Company after company, iterations after iterations, CFOs pointed out where assumptions didn't reflect reality. CEOs showed where operations weren't properly connected to cost. Departmental heads highlighted missing details that genuinely mattered to how the business actually ran. Each adjustment removed friction. Each refinement increased transparency, insight, and control. And what you see today is the result of that process. It is a nested suite of driver-based models, fully integrated and double-entry compliant. It is not just a financial model. It is a finance operating framework designed to work the way real businesses actually work. Chapter 3, Inside the Architecture. Let's step into the model and take a look at how it is structured. At first glance, the architecture might look robust, but it's intentionally streamlined and designed to reflect how work actually happens in finance. The model is organized into 3 layers. Layer 1, input models. This is where everything begins. For the actuals, I've got Power Query here acting as the engine room. Data from multiple entities coming from multiple sources. These sources are harmonized, validated, and then reconciled. What comes out is a single, structured, clean, consolidated data set ready for reporting and typically presented as a fully sliceable rolling 3-year actuals view. For the forecast, whether that's 12-month budget, rolling quarterly forecast over a 5-year plan, this is where operational drivers actually live. Across roughly 10 dedicated input models, every entry you make, adding an employee, introducing a revenue line, planning a cost item, flows directly from operational input into the financial engine. You have no duplications, you have no rekeying. And then it takes us neatly now to layer 2, where you have the detailed principal financial statements. The outputs of those individual input models become the inputs right here. This is where the data becomes structured financial information, detailed principal financial statements, and then cost center P&L, KPIs views that are immediately usable for onward reporting. And all of that takes us to layer 3, the management reporting package. This is where everything condenses. All the work flows into a management reporting package that is designed to be user-friendly, but content-rich. Every line in the profit and loss, balance sheet, and cash flow statement can be traced back to its operational origin. The model works horizontally, from 3 years of historical actuals through the current budget and across multi-year plans. It works vertically from consolidated group view down to individual departments and line items. Chapter 4, from one line to the full picture. Let's move to the part where the model really comes alive. What I'll do is I'll be starting with something deliberately simple, and I'll be doing a single line entry in each input module. This is exactly how the model is meant to be used in real world. One entry, one driver, one operational fact, and then you can immediately see how all of that then flows through the entire system. The first one, starting with the permanent employees. I enter one employee here, the salaries, the FT, the start, end date, if applicable, bonus percentages, the whole 9 years, and then instantly the model calculates monthly salaries, bonus accruals, employer national insurance benefits, and recruitment related costs. From there, we now go to the next one, which is the temporary employees planning model. One contractor line, daily rate, FT, VAT, payment terms. And you can see the output of this straight away: the monthly cost profile, VAT calculations, headcount movements. From there, we now go to the subscription revenue or recurrent revenue planning model. I'm with a single customer here: the unit price, the contract duration, the commissions, days sales outstanding, and you see the model updating, recognizing and deferring revenue, VAT, cash receipts, and customer count. Next is the subscription cost of revenue model that mirrors this on the supplier side, showing deferred and recognized costs, trade payables, and VAT. For services-based businesses, the service revenue planning model uses one project line, billable hours, non-billable time, utilization, and professional development. And you see the capacity, you see the revenue, you see the cost as they all move together. This now takes us to the next model, which is the transaction revenue planning model that tracks single sale, product revenue, cost, margin, VAT, and customer churn. From there, we now go to the overheads planning model. Using the same thing, which is a one-line entry for, say, rent, marketing, or any other operating expense, we have the recognized cost, the deferred amount, the VAT that's inclusive, and then you have the trends updating automatically. Finally, we have the cash book and capital expenditure, both of them separate planning model. Here you have the loan drawdown or an equity injection or an asset purchase. And with the one entry for the cash book, you see the balances updating properly. And then for the fixed asset, you have the depreciation schedules that are created, net book value flow through the statement. Now let's jump quickly to the profit and loss, the balance sheet, and the cash flow to see what all of that has created for us. And we see that even with just one single line entry, you can see already the system work. Chapter 5, from inputs to scale. First of all, let me show you the data sets that we'll be using here. These are things you would have within your company. And this is going to be something really powerful. And this is where we do the bulk data input. And with a simple click from the command navigation page, you can load data for a small company, medium-sized, large company directly into every input field across all the modules. What was a control demonstration a moment ago is now a fully populated financial representation of a real business. Thousands of lines across employees, contractors, subscriptions, services, and transactions, complete outputs flowing into the detailed principal financial statements of the profit and loss, the balance sheet, and the cash flow. This is where the model starts to show its depth. You can follow month-on-month movements, you can follow the review of the departments, you can follow group-level financial statements, and work with that data that's immediately ready for transformation, scenario analysis, and strategic decision-making. Even complex data-heavy organizations can be modeled quickly whilst maintaining full transparency, traceability, and operational insight. And the key here is very, very simple. This is the power of a driver-based, fully integrated FP&A system, one that is designed to let finance teams truly partner with the business and not just report on it. Chapter 6, From Data Decisions, the Management Reporting Package. Now that the model is fully populated, this is where everything comes together. What you're now looking at here is a management reporting package. This is not a separate model. It is the natural destination of all the work that's already happened upstream. We start with the executive overview, one page, one business view. At the center of the management reporting package sits the executive overview. This is a single page that brings together the full profit and loss, balance sheet, and cash flow statement, year on year in thousands, alongside the most pivotal KPIs. Everything here is designed to be read from the top down, the way executives naturally think about the business. We start with the profit and loss at the top. You see the total revenue, cost of revenue, gross profit, and gross margin. From there, the operating cost that flows through the SG&A leading to the total operating expenses, EBITDA, and EBITDA margin. Below that, we have the operating income, earnings after interest, and net income, each shown both in absolute terms and as a percentage of revenue. Nothing is isolated. Margins, profitability, and scale are visible together. Built-in checks ensure that the statement always remains coherent and complete. Directly beneath it sits the balance sheet. Total assets, total liabilities, net asset, shareholders' funds, and total equity. This is not treated as a static snapshot. It moves in line with the profit and loss and cash flow, with internal balance checks reinforcing integrity and confidence. From there, the page now flows naturally into the cash flow statement section, where you have the cash from operating activities, cash from investing activities, and together, these give what many consider as the holy grail of finance, the free cash flow. Financing activities follows naturally, bringing the picture together into the net cash movement. From operating cash through the cash movement, we now get the closing cash. Again, with checks in place to ensure everything reconciles cleanly. The lower section of the page brings in operational key performance indicators presented as actual units rather than abstractions. You see headcount movements, opening, additions, levers, and then the closing positions. You see services capacity, client hours, professional development, statutory time, and total hours, along with utilization and realization rate per client hour. Revenue and cost per resource, contribution per resource, both in absolute terms and percentages. Customer dynamics are visible at the same level. And that now takes us to the subscription client count. Opening, addition, levers or churn, and then the closing position. Do the math, that gives you the ARPU, average revenue per unit, driven directly from the underlying operational inputs. And then finally, cash versus the expenses, a clear practical way of the financial runway. Moving from there into the P&L analysis, the structure stays familiar. Revenue is broken down by the streams, subscription, services, transaction, and gross margin, clearly visible and consistent across periods. Operating cost follows the way the business is actually run, all aligned to departments, not accounting labels. You can now move horizontally, quarter on quarter, year on year, and then vertically to see the group level down to the individual cost centers. The balance sheet isn't treated as an afterthought. Trade receivables reflect real customers' behavior, payment terms, deferred revenue, and deferred costs tied back to the contract structure. Fixed assets depreciation, net book value flow directly from the capital expenditure planning module that I showed you earlier. Working capital movement therefore becomes visible, explainable, and predictable. The cash flow completes the picture. Cash movements are no longer a reconciliation exercise. They are the results of timing, structure, and operational decision. You can see when cash is generated, when it is absorbed, and why runway and liquidity are not calculated in isolation. They emerge naturally from the model. Then comes the key performance indicators. Like was done on the executive overview page, I would like to dedicate some time to move into the key performance indicators. This page is not designed to overwhelm. It's designed to help leadership interpret business financially, operationally, and strategically using consistent year-on-year, quarter-on-quarter measures. All KPIs here are derived directly from the same underlying engine that produces the profit and loss, the balance sheet, and the cash flow. We begin at the top. The profitability ratios. Here we see the gross profit margin, the net profit margin, EBITDA as a percentage of revenue, returns on equity and assets, and net gearing. Together, these show not just whether the business is profitable, but how efficiently capital is being deployed and risk is being managed. Next, we're looking at the liquidity ratios, where performance meets financial resilience. Operating cash flow ratios, current and cash ratios, working capital and free cash flow converge, and cash runway. This section answers a simple but critical question. How long can the business sustain itself under its current operating model? We then move into activity ratios. Days sales outstanding, days payable outstanding. These metrics connect operational discipline directly to cash behavior, making working capital efficiency visible and measurable. From there, we now take a look at the debt ratio. Overall leverage, debt to equity, interest coverage. This provides immediate context on financing structure, risk exposure, and the business ability to service its obligations. Customer performance sits alongside financial health. Sales and marketing investment, customer retention, opening, added, and lost clients, leading to closing client counts. And then that takes us now neatly to the customer acquisition cost, subscription revenue, average revenue per unit, short into ARPU, gross margin per unit, client growth and churn, percentages, and then you have the customer lifetime value, CLT for short. These are not marketing metrics in isolation. They are unit economics tied directly to profitability and cash. For professional services businesses, the model goes deeper still. We start with the client hours utilization, realized rate per client hour, headcount across professional services resources. From there, we have the revenue cost and contribution per resource, both in absolute terms and as percentages. This is where pricing, capacity, and margin intersect. At the business level, we track growth momentum. We have the revenue growth, profit growth, clear indicators of trajectory, not just scale. And then finally, the page closes with the departmental closing headcount. Here we see the operations, the network, cybersecurity, IT support, research and development, security, finance, marketing, sales, human resources, HR for short, management, and general administration. These are the ones I have used in this model. And then all of that takes us to the total headcount. This gives leadership a precise view of the organizational shape and cost footprint at any point in time. This is how KPIs stop being just reports and then start becoming decision tools. Beyond the executive overview and the KPI pages, the management reporting package continues with a set of views designed to support decision and deeper analysis without breaking coherence. The next pages introduce the transformation impact report, version 1 and version 2. These focus explicitly on showing changes before and after views of strategic initiatives and operating decisions. I'll return to these particular sections in detail in the next chapter, where we then step into transformation and scenario management. From there, we move into the Departmental P&L or profit and loss. This is intentionally simple. Just by using the simple drop-down selector, you choose the department you want to analyze, and instantly the model then updates to show that the department's P&L using the same structure and logic as the group view. No alternative layouts, no parallel calculations, just a consistent lens applied to a different level of detail. The package then concludes with the cost center trend and contribution report. This page brings together financial performance, operational capacity, and contribution year on year, quarter on quarter by cost center. At the top, you see the contribution. Here you're seeing a directly generated revenue from departments, particularly within the professional services, flowing into consulting revenue. Against that, you see the total direct people cost by department, rolling up into total people cost. From there, you have the net contribution or loss, which is clearly visible, along with contribution margin. Beneath this sits the operational layer. You see your headcount movements, opening, addition, levers, and closing. Services hours, client hours, professional development, statutory time, and other hours leading to total capacity. And then from there, we now calculate the utilization percentages, realization rate for every client hour, connecting time, pricing, and revenue. These then translate into per resource economics, where you're looking at the consulting revenue per resource, people cost per resource, contribution per resource, both in absolute terms and as percentage. And finally, we have the cash versus expenses, a practical view of the financial runway at the cost center level. What's important to bear in mind here is not the number of reports or the volume of data. It is the consistency and the relevance of each page. Every view has been carefully thought through in terms of what it shows, why it exists, and how it supports decision making. Every page in this package is looking at the same business, but from a different angle, at a different level of detail, without breaking logic or integrity. This is the point where finance stops explaining numbers and starts facilitating decisions. And the beauty of this reporting is its seamlessness. You have one single model, one single source of truth, driving operational insight, financial analysis, and strategic reporting at the same time. From a single line entry to a fully populated data-rich organization, the outputs remain consistent, traceable, and actionable. This is where FP&A becomes more than reporting. It becomes a true strategic partner to the business. Chapter 7, from planning to transformation. Now that we've explored input, outputs, and management reporting, this is where the model becomes truly strategic, because real businesses don't operate in a static environment. Costs move. Revenue models evolve, headcount and operations, they change, strategic decisions, whether a product launch, restructuring, or an acquisition, they create ripple effects across every part of the business. This is where the driver-based model matters. With this particular model, you can introduce deliberate change. A one-off hiring initiative, subscription price change, adjustments, the cost optimization program, a capital investment, or a refinancing event. And you can see immediately how these decisions flow through the P&L, the balance sheet, and the cash flow, and the operational KPIs. I'm going to be starting small, but before I do that, let me show you how this transformation impact report actually works. I'm going to move contents from this section to the other section, and then from there you now see the pre and the post transformation sections updating. Here now you see that you have no differences, but when we now start making the changes, everything will start to make sense. Now let's step into a broader transformation. Starting from the imported bulk dataset that we used earlier for a mid-sized company, we apply a set of strategic initiatives. And I'm going to be doing a reduction in force, revenue unit price changes, cost optimization across overheads, renegotiating financing terms, and the launch of a new product line. The model now produces an immediate pre and post-transformation view. You see the profit and loss, the balance sheet and cash flow, the delta from current operations to projected performances. KPIs have updated dynamically. Output, churn, utilization, professional services capacity all remain tied back to the operational drivers. This you start to see is more than scenario analysis. It is a transformation impact report in action. Stakeholders can see exactly how each decision affects cash, cost, revenue, and profitability. Departments understand how their actions contribute to the outcomes, and leadership gains confidence, not just in numbers, but in the assumptions behind the numbers. The real value lies in traceability and flexibility. Every scenario is fully auditable. Inputs remain linked directly to outputs. Multiple scenarios can be compared side by side. Even complex multi-year strategic decisions become understandable, defensible, and above all, actionable. From different perspectives, the value is clear. For the CFO, it enables rigorous scenario analysis while maintaining audit-ready integrity. For the COO, it shows how operational adjustments cascade through financial outcomes. For investors, it builds confidence that decisions are grounded in transparent driver-based logic. And here's the key point. All of this, single line entries, bulk data inputs, and complex transformation scenarios, runs in the same model. The logic doesn't break. The output remains consistent, and finance moves from reporting the past to actively shaping the future. Chapter 8. How companies engage with this framework. What you have seen throughout this walkthrough is not a theoretical construct. It's working finance operating framework. It's been built, tested, and refined inside real companies under real constraint with real decisions at stake. So the natural question becomes, how do companies actually assess and use this capability? The answer is deliberately flexible. Some organizations engage with this framework to establish a solid FP&A foundation, bringing structure and coherence to planning by replacing fragmented spreadsheets with a single integrated driver-based system. Others adopted during periods of change, fundraising, restructuring, and rapid growth, or post-acquisition integration, when clarity, speed, and confidence in the numbers matters most. But irrespective of when companies engage with it, the framework quickly becomes central to a monthly management review cycle. It is the model leadership teams return to month after month to understand performance, to review variances, and to frame the decisions ahead. As a result, in all cases, it evolves into the ongoing finance partnering platform, supporting monthly management reporting packages, budget and refocusing, scenario analysis, and strategic decision making over time. The model itself is not dropped in and then walked away from. No, it doesn't happen. It is configured around how the business actually operates. That starts with the fundamentals: the chart of accounts, the trial balance, and the activity level reporting. From there, it extends into the drivers that matter: how revenue is generated, how costs are incurred, how finance is structured, how operations translate into financial outcomes. Revenue streams, cost structures, organizational design, and strategic objectives are not abstract concepts here. They are embedded into the model's logic. And from lived hands-on experience across FP&A, a few things consistently stand out. Operational teams engage with drivers they recognize. Finance regains and retains control, integrity, coherence. Leadership gain visibility they can trust and rely on. What makes this approach different is not the tool, it is the mindset. Finance stops being the function that reconciles outcomes after decisions are made and becomes the function that helps shape those decisions before they are taken. So, whether you're building FP&A from scratch, enhancing an existing FP&A capability, or engaging around project-specific transformation, whether the need is clarity, scalability, or change, this framework adapts without losing discipline. One system, one source of truth, one way of connecting operations, finance, and strategy. And now that you've seen how this model supports FP&A end-to-end, if you're already having a model that truly reflects how your business operates and helps you decide where it should go next, then generally good on you. And if you don't, I'm overly confident that now that you know what this model can do for you, you know what the next step is. Let's talk.